All right, hello, this is Melissa, the insurance exam queen, and this is going to be a lesson on life provisions, riders, and exclusions. This does tend to be one of the heavier tested topics, regardless of what state you are in. And the good news is if you're doing both the life and health exam, a lot of these life provisions will double dip in the health side, and I will alert you to that when there is a life provision that is the same as a health provision, because it helps with your studying. But again, this is a very highly tested chapter throughout any state that you're in. Like in Texas, it's 14% of the exam. It could be a pretty big chunk, regardless of the state. Now, life provisions, let's just talk about what this is for a second. And then I'm live teaching in a boot camp. We're not even talking about the types of policies first. Like, it really doesn't matter knowing term versus whole yet as we're going through this lesson, because these provisions can be pretty much applied to any type of policy. There are some that are specific to whole life insurance, and we'll separate those. But the main thing about provisions is that they're kind of like ways of doing things, or extra things, or like a rider is an extra thing that you can add to the policy. So when you think of a provision, it's just, this is how the policy is. It's just this way. You're not going to be tested on the definition of a provision, but I just wanted to, explain what it is. So when you issue the policy, it's like this, it has this is a feature, this is a component of the policy, and that's what a provision is. A rider is going to be extra insurance, usually an endorsement or an addendum that you're adding something extra onto the policy. And the key thing about riders is that they're generally going to cost you extra money. So if you're adding on extra insurance, you're adding on an extra benefit, it's going to cost you additional premium. And then exclusions are things that are not covered on the policies, and there aren't too many for life. The biggest ones I think are like pilot. If you are a personal pilot, not a commercial pilot, like if you fly for Southwest, that's fine. But if you are a personal pilot, you have your own pilot's license, they don't like that. I think that's the main. And then war can be good, but we'll get into that. All right, so as we'll go through these, I'll explain each one. Again, since you're live here, Haley, make sure you ask me any questions. And these are again, this is one of the most tested topics. So you want to make sure you know this stuff really, really well. Okay. So the first one is called a waiver of premium. Oh, we got another person. Here we go. Hello, Rhonda. Okay, so the first one here is waiver of premium, and this one is really cool. So if you become disabled, which means you cannot go to work, you cannot earn an income because you are disabled now and somehow, you are not receiving money, you don't have an income. So eliminating your life insurance bill is nice. That's what waiver of premium is actually doing. So when you owe money, you pretty much owe money every month or every year for your life insurance. And if you become disabled and you're not receiving an income, trying to pay that bill can be hard. So with the waiver of premium, and this is actually a rider where you can add it on, you can add it extra to your policy. You have to pay to add this on. But when you add this on, if you become disabled and you cannot work and you cannot collect an income, the insurance company will waive your premium for you. You won't have to pay it. Basically, you're getting free insurance for as long as you are disabled. So truly, like if you're so let's say you buy your life insurance policy this month, and then next month you're in an injury that doesn't kill you, but it disables you, and now you can't work, and your life insurance is good for the next 30 years. You would have free insurance for the next 30 years. They will waive the premium the entire time that you are disabled if you have this premium, waiver of premium on there. Now, there is one little thing where there is a 6-month waiting period. So this is when you think about this, you kind of think of like a deductible. So what this is saying is for the first 6 months. So if I become disabled today, 6 months, I will still need to pay the premium. So it's not waived for the first 6 months. I still have to pay it. However, if I am still disabled at the end of the 6 months, they will actually back pay me all 6 months of premium. So if I am still disabled, so I get disabled, still disabled, still disabled, still disabled, still 7, I'm now into the 7th month, they will refund me all of the premium that I paid. If I get better during that 6-month period, they won't waive the premium and they won't pay me back. So it's basically saying they're checking to make sure that you are going to be disabled for a while before they waive it. And as long as you are still disabled by the end of that 6-month period, they waive it going forward until you get better. And they will refund you any of the premiums that you paid. So this is the, and then as soon as you get better, when you're no longer disabled, then you're going to go back to paying the premium. So some disabilities last 6 months, a year, 2 years, some are lifetime. But if they're anything less than lifetime, at whatever point you get better and you're able to go back to work, you will need to pay the premium again. So the key thing with the waiver of premium is that if you become disabled and you cannot work, they will waive the premium. But there is that 6-month waiting. This is probably right here the most tested topic from this topic. The subtopic of this is that there is a 6-month waiting period. The premium will be waived after that date, so long as you're still disabled, and they will refund you any premium paid during that 6 months. But if you get better 3 months in, they don't waive the premium. They don't repay you back. Okay. All right. Oh, and I kind of wrote that out here too. So here's just another way of seeing it listed out. Allows the insured to waive the premium for the insured if the insured is totally disabled. So they waive the premium. They don't make you pay it. There is a 6-month period before the premium can be waived. So for 6 months of disability, you will still pay the premium, but at the 6-month mark, the premium is waived going forward, and any premium paid in the last 6 months will be refunded by the insurer. So again, I wanted to make this as a study tool. So not only do you have the picture representation, you have it spelled out for you as well. All right, now the next one is similar. It is almost exactly the same. The difference is that this is where the payer, this is the person who pays the premium, is different than the insured. So for instance, let's say a mom buys an insurance policy for her son. So the son is the insured, but the mom is the payer. She's the one who pays the premium, so that if her son were to die, she would get money paid out so that she can pay for his funeral or whatever. So the mom, if the mom becomes disabled, so let's say the mom becomes totally disabled, she'll still have that same 6-month waiting period, works exactly the same. And then the premium will be waived. It will continue to be waived until the son reaches age 21, and then he would be responsible to take over the premium. So, and this is typically used in juvenile policies. It doesn't have to be juvenile. Like even if a wife buys a policy on her husband and the wife becomes disabled, she can get the premium waived, whether her husband is totally fine or not, right? It doesn't matter. The payer benefit is not about the insured. It's about the person who's responsible to pay the premium. Basically, that's the owner of the policy, but it works the same way as the waiver of premium, except now technically, if the mom gets better, right? So if she gets better over here, they will stop waiving the premium. Or if she stays disabled the whole time, then it will go until the son reaches 21. So again, with any disability, anytime the person gets better and they're no longer disabled, they stop waiving the premium. In this example, we're saying the mom is totally disabled forever. So then once her son reaches age 21, he will then have to take over the premium. Okay. All right, next up is guaranteed insurability. Now, this one is pretty cool. So when you buy your life insurance, and this kind of comes from completing the application field underwriting chapter, you learn that the insured, the person who's wanting to get the insurance, has to answer medical questions. And those medical questions, those history questions, can determine if we're going to be willing to offer the insured insurance or not. And when I say insured, applicant, right? So you're not insured until you get a policy. But if you come to the insurance company and you've got all kinds of medical problems, you already have all these diagnoses, cancer, you've got all this stuff on your medical record, they're not likely going to offer you insurance. If you are healthy and everything's fine, then they will give you a policy. That's called insurability. If you're insurable, it means they're willing to give you a policy. If you're not insurable, they aren't willing to give you a policy. So anyone who wants insurance needs to be insurable. You can't have too many risks. So like insurance is the transfer of risk. So if you're too risky, they won't take the transfer. If you're already 90 years old and you're trying to buy an insurance policy, they're like, well, you're already really close to the point of dying. We know we're going to have to pay out. Now, there are some policies like final expense. It's literally final expense. They know that you're going to die and it's just money for the funeral. So you might be able to buy that one when you're 90, but you're not going to be able to get $1 million policy when you're 90 years old because they know you're going to be dying soon. You're just older. It's just natural, or it's a part of being a human, that the older you get, the closer you are to dying. So a 90-year-old trying to get $1 million would not be insurable. So guaranteed insurability. Now, what this is doing is it's allowing you to pay and lock in the fact that you're insurable. So let's look at some examples that we've written out here. So let's say at the top here, we have a guy. So the insured buys $100,000 without the guaranteed insurability rider. So he decided, I don't want to buy this. Because remember, if it's a rider, it's going to cost you extra money. You've got to buy it extra on top. And it's a choice. You don't have to get it or not. It's if you want it, you pay for it. If you don't want it, you don't get it. You don't pay for it. So he decides to buy his policy without it. A few years later, the insured wants to add more coverage since he got married and he bought a house. Okay. So he's like, oh, now I have a wife I have to worry about. I've got a house. I've got a mortgage that I have to pay. I need more insurance so that if I were to die, the money would pay out for the mortgage. So the insured calls the agent, who begins to ask health questions. He's asking health questions because he didn't buy guaranteed insurability. And if we're going to insure you for more, we need to confirm that you are still healthy, that you're not super risky. So based on the answers, the insurer says they cannot increase the policy. So let's say like at some point in between here, he was diagnosed with like skin cancer and it makes him uninsurable. They don't want to offer him insurance because now he's too medically risky. So they say, sorry, we're not going to increase the policy. Now he can still keep his $100,000. They're not going to take that away from him. That's already locked in. That's already secure. As long as he pays the premium, he'll continue to have that policy, but they're not going to offer him any more insurance because of his medical history. If say he were to have skin cancer or something like that, right? Now, in the other example down here, this woman, she was smart. Women are smart, right? The insured buys a $100,000 policy with the guaranteed insurability rider. Okay. A few years later, the insured wants to add more coverage. They got married, want to buy a house. Okay. Wouldn't it be funny if if they married each other and the wife would be like, you should have gotten that guaranteed insurability. Why didn't you do that? So anyway, the insured calls the agent to increase the coverage and the agent does it. No questions asked. No questions asked. They just immediately do it because she's guaranteed insurable. Basically, it's saying she's just as, when you get guaranteed insurable, it's saying you're just as healthy as you were the day you signed up. Now, she will still need to pay extra premium for the coverage, right? It's not to say you get free insurance. They're just not going to ask you medical questions to determine if they're going to give it to you and to how much. When they add her coverage, they will add it at whatever new age she is, assuming the same health that she had when she first applied. So she will still pay the extra money to increase the coverage, but they won't tell her no, and they won't even ask medical questions. She could technically be terminally ill. She could be terminally ill, and they would still increase it. Now, the thing with guaranteed insurability, though, and I wonder if I put it here. Yes, okay. So it allows the insured to call in at certain ages. So it's not to say you can call in every single day and add more insurance. You have to have reason for it. You have to have a backing for it. So it allows the insured to call in at certain ages, usually every 3 years or so, or at major life events like a marriage, a baby, buying a house, to increase the coverage on their policy without having to prove that they are healthy. So again, it's not to say every day you can call in and add more coverage, but every so often, either every 3 years or at every major life event, you can call to increase your coverage, and they will not ask any medical questions. They simply allow you to add more insurance, and then you will only pay for the cost of having the extra amount of insurance. So your premium will go up, but only in accordance to however much insurance you bought. And that is the guaranteed insurability rider. So it avoids medical questions, allows you to just boop up your coverage as much as you want.
I have a question.
Yes.
Okay, so these are all provisions and then the riders are included?
Sorry. When this says life provision, so back at the title, I'm not necessarily doing provisions first. They're kind of all over the place. But provisions are the way we do things. The way we do things.
Yeah. Okay.
Riders are extra, and they're going to cost you money. So right now, this is a rider. Okay. The thing is they're not going to ask you what's a rider and what's a provision. So it doesn't like super matter necessarily.
Okay.
But so far, so waiver of premium is a rider. Waiver, this one's a rider. Payer benefit is a rider. Guaranteed insurability is a rider. Same. So far we've talked about riders.
Okay. I didn't know if it made a difference or not.
Yes and no. You want to know that a rider does increase the premium. A rider is going to cost you extra money. Mm-hmm. But in terms of them testing, do you know if this is a provision or a rider? They don't really do that.
Okay.
And they'll usually say it. They'll say like for the guaranteed insurability rider, like they'll put it in the question. So they don't really ask you the difference between a provision and a rider. It's not really a testable point, but great question to clear that up. All right. So the next one is the payer benefit. Oh, this got moved around. This is supposed to go, sorry about that. This slide is supposed to go under number 4, but I can't move it because I don't have a mouse. I don't have a way of moving. Oh, there we go. Okay. So that way, so when you're using this as a study tool, you'll have the payer benefit with the picture, and then you'll have the explanation of it. So we talked about this again. It's this is where a different person buys a policy on someone else. The payer, the mom, becomes disabled. They will waive the premium if the payer, the person paying the premium, becomes disabled. Same rules apply as we learned in waiver of disability. There is a 6-month waiting period. If the payer is still disabled after the 6 month, the premium will be waived until the disability is over or until the child reaches a certain age. And it could be 18 or 21, but 21 tends to be more common. Because usually, you still got to get a job, so you're still in high school sometimes until you're 18. So they try to give you a couple more years to get a job, get established, making money. Okay. All right. And then, so this was the guaranteed insurability. So we got that one. That one's also a rider. All right. Then we have accidental death. This one is also a rider. So you can add this on for extra insurance. Now, what this one will do is, so life insurance covers you however you die, usually speaking, unless you commit suicide in the first 2 years. That's actually a provision. Later on, we'll learn about that if you do commit suicide in the first 2 years of the policy, they won't pay out the death benefit, but they'll refund you any premium, refund your beneficiary any premium. But pretty much any reason that you die is covered by insurance. So whether you die of a stroke, a heart attack, a car accident, a bear attack, whatever reason, choking, whatever reason you die, life insurance is going to cover you. Now, what this rider is doing is it's going to double or triple your death benefit if you die from an accident. So you're already covered if you die from an accident. Like, don't get me wrong. This is not saying that your regular insurance doesn't cover you if you die from an accident. This is just a multiplier that if you do die from an accident and you've added this rider on, it will double or triple your death benefit payout. Because usually sometimes when you think about accidents, they're like, let's say it was an accident where you were in a major wreck and you were still alive at the accident and they had to airlift you to the hospital. You can have major medical bills. There might be some extra expenses related to dying from an accident. So they allow you to do this. Now, there also is separate policies that are just accidental death policies. So you can buy, and this is something, unfortunately, this happened to my grandma. So as a life insurance agent, please make sure that you're informing your customers correctly. But there's a lot of like banks and credit unions that will send little letters to people saying, hey, buy our accidental death policy. It's only $2 a month. All you got to do is sign up. No medical questions asked. So my grandma did that for my grandpa, but she didn't realize it was accidental death only. And so she's like, well, I have a life insurance policy for him. I'm like, Grandma, this won't work. He didn't die from an accident. He died from being an old man. So that's unfortunate. So but yeah, so this could be a whole separate policy all by itself, specifically for accidental death. But for the purposes of the exam, we're learning this as a rider. So what this will do is it's a multiplier. So when you buy your regular insurance, and if you die in any form or fashion, it will pay out. And if you die from an accident and you have this rider on, it will double or triple your death payment when you die from an accident. Now, a couple of rules about this one is that the death must be truly accidental. So like, let's say someone was in a car accident and you think, oh, they were in a car accident. This is an accident. But if they do an autopsy and they find out that the person, had a heart attack, that's not really accidental. That was a medical thing that caused them to crash the car. So in something like that, they wouldn't actually pay out. Like, it has to truly be an accident, something that was totally out of the blue, like hiking and falling down the cliff, a bear attack, a car crash, truly a car crash, a plane crash, something like that. The other thing is that the death must occur within 90 days of the accident. So in the case where you were, like, let's say you were in a major car accident and you're airlifted to the hospital and you're in the hospital for a while and they've got you plugged onto the machines and the doctor's like, we don't really know if you're going to make it. They're only alive right now because the machines are on. Your family would literally need to pull the plug on day 90 within 90 days in order to get that double or triple indemnity. If they decide not to pull the plug and you die on day 91, they lose that double or triple money. You have to die within 90 days of the accident. This could also be like, let's say you were in a bad car accident and you got like significant trauma to your body, but they were able to do surgery and you're okay, but they send you home, but then you get an infection from the injuries and then you end up dying, that would still be covered under it. So that's where that 90 days comes from, is there's wiggle room in that. But is the death has to come from the accident and it has to be within 90 days. Now, if you have a car accident, you're totally fine. You walk away and you die 60 days later from COVID or something else, that's not going to work. It has to be from the accident. And within 90 days. This is probably the most testable point when it comes to accidental death, is that it has to occur within 90 days. And that it does have to be truly accidental. So for an example, the insured owns a 100,000 policy with an AD rider. If the insured dies in any way, they'll get 100,000, right? Your life insurance will always pay out no matter how you die, generally speaking, unless it was like again, a exclusion of the pilot. But if the insured dies from an accident with the rider, their payout will be 200,000 if they had double indemnity and 300,000 if they had triple indemnity. So the word indemnity, by the way, not necessarily always tested on a life insurance exam, but this is basically the payout from the insurance. So when you get paid out from the insurance, they're trying to indemnify you and they're trying to restore you to your previous financial condition. Kind of is weird on life insurance, but when you think about, like, if this is $100,000 policy, that could be like a year's worth of income. And you're trying to restore the year's worth of income to the person who died. They're no longer able to work because they're dead. And so you're restoring their income. But indemnity is basically what they pay out to you to restore you to your previous financial condition. Not really a testable point on life and health. It is super testable on P&C, property and casualty, but you're going to see that word. So I wanted to, you'll see it as double indemnity or triple indemnity. So I just wanted to make sure you understand that's the payout. So they're going to either double the payout if you have double indemnity, or they will triple the payout if you have triple indemnity. And that's accidental death. Now they also have another one called accidental death and dismemberment. So everything we learned about accidental death is exactly the same. You have to die within 90 days. It has to truly be an accident. Then they're adding on dismemberment. Dismemberment is like losing a limb. Losing a limb. This is where your arm gets cut off, your legs get cut off, or you're in an accident where you lose an arm, you lose a leg. Okay, so there's some sort of accident that causes a dismemberment. Now, if you have diabetes and they surgically remove your leg, that's not an accident. Okay, not a medical amputation. This has to be truly accidental that causes you to lose an arm, lose a leg, lose a foot, lose a hand. You go swimming, a shark bites off your hand, dismemberment, an accident that happened and you lost a limb. Now with dismemberment, they will pay out in two different ways. They will pay out, for an AD&D policy, it pays out two different ways. Principal sum, which basically just means the full amount. So this is the full amount, whatever this is. Now, an AD&D can be a rider or it can stand alone. If it's a rider, it'll just pay out whatever your life insurance is. And then if it is its own policy, it'll just pay out whatever that amount of insurance is. So principal sum pays the full amount and it will pay for death or two limbs. So principal is death or two, and you get the full amount. So principal is the full amount and it'll pay out the full amount when you die or you lose any two limbs. Capital sum is going to be a percentage. Usually it is going to be half, and it will pay for the loss of one limb, 1 foot, 1 hand, 1 leg. So if you lose just 1 arm, they will pay you half of the amount of money. If you lose 2 arms, they will pay you the full amount of money out. The testable question for this one that I have seen a lot is they'll say, what are the payout options under an accidental death and dismemberment policy? And the answers are principal and capital. Like, you just need to know that these are the ways that the policy pays out. Or they'll ask you, the insured died under an AD&D policy, what will be the payout? It'll be the principal sum. It'll be the full amount. Or an insured lost one limb on their AD&D policy, what is going to pay out? The capital sum. It's half of that. Now, this one will also be, if you're studying the health exam, this will also show up on the health exam side as well. This actually is a health, when you come to the dismemberment side, I mean, accidental death is definitely like life insurance, but you can get this as, they teach this on the health policy as well. So these are double dippers. AD&D is a double dipper. It helps you on both the life exam and the health exam. For the purposes of the life exam, they really focus on that double or triple indemnity. For the purposes of the health exam, they really focus on the principal versus capital, because that's where that dismemberment comes in, is on the health side. All right, moving right along. Next up, we have riders covering additional insured. So obviously this is a rider that we're talking about. And remember, riders are going to cost you extra money. When I think of a rider, like I think of like those little, like a motorcycle, and you know that like they have like a little sidecar. Like the motorcycle is the policy. And then you can choose to add the little rider that rides alongside the policy with you, and extends your coverage on the policy. So riders covering additional insureds, this just allows the insured to cover additional people on their policy. So like this could be pretty common, like when you have one spouse who's the worker and the other spouse stays at home. You don't want to have to pay a ton of premium to have two different policies, but you want to make sure both are insured. So you can buy your own life insurance and then add your spouse or your children to it, or your whole family to it. So your spouse is going to be added and covered the same as the insured. So whatever, so you'd pay extra money to add them onto your insurance. So you'd have one policy instead of two, but it's covering the both of you. But with this one, it's usually going to expire when the spouse reaches age 65. So even if you have a whole life, and a whole life, we haven't gone over that yet in this live boot camp, but whole life goes for your whole life, like until you die. So that'll go to age 100, even, or if you die before age 100. But when you add your spouse, they're not going to get whole life. They're only going to get it till age 65. So even if I have a whole life policy, when I add my spouse, it's a term. All of these really are term. So riders adding are term policies, and term are known as temporary, not permanent. Whole life is known as permanent forever. You can add children to the policy, and they can be added for a limited time as well. Children, basically 18 or 21. And again, this comes, if generally, especially if your kid goes off to college, you're still supporting them into their 20s. Now, what's really cool is that if you do add your children, when they come off the rider, the insurance company will actually offer them their own whole life policy without evidence of insurability. Now, this is really cool. Like, for instance, if, like, let's say you have your policy, you add your child to it. Your child is young and healthy, low premium. Let's say in their teen years, like me, actually, I had thyroid cancer when I was 16. If I was on my parents' policy and I had the thyroid cancer at 16, and even though it was cleared up, I did actually try to buy insurance. After my cancer diagnosis, they told me I had to wait 5 years, that I was uninsurable for 5 years after my cancer, that they wanted to see me in remission and making sure that it wasn't coming back. So for 5 years, I had no way of buying insurance. But had I been on my parents' policy as a children's rider, as soon as I turned 18 or 21, whatever the age was, they would have offered me a whole life policy without any medical question, and I could have been able to buy it. So this is a way of making sure that your children are protected forever, because you never know what could happen. Your child could get cancer at 16. Your child could be in an accident. Your child could get diagnosed with something. So and I'm pretty sure you don't even answer medical questions when you add them on to begin with. They just assume healthy children. So this is a way of making sure that your children are always able to have insurance by adding them onto your policy. And then when they age out, you get them their own without having to answer any medical questions, and they can have that insurance forever because it is a whole life policy. You could also just do family, which is just a combination of spouse and children, no problem. And then they have non-family. Now this one is a little weird, not nearly as testable. This one is for business insurance. So this will come from the types of life chapter, where you can actually get insurance, like two business partners can get insurance on each other, and a company can get insurance on like their CEO, or any person who is crucial to the business. You can get insurance on them so that if they die, you have the money to find and train their replacement. So non-family is generally when a business buys a key person insurance. So key person is like CEO insurance. So a business has a CEO, the CEO dies, they want money to pay out so they can find and train their replacement. With CEOs, they tend to, work at the company for a while and then leave. So when you have a key person, they simply just change the name of the insured, and they do it technically using a rider called a non-family rider. It basically just allows them to change the name. So he went from this CEO to that CEO, and it just allows them to do that. Not a highly testable point, but I wanted to throw it in there just in case you see it. I think the spouse and the children, I think, are probably the most tested, where with the spouse, they want you to know that it expires at age 65. And then with the children, it's good until age 18 to 21. Those I would say are probably the most tested points when it comes to riders covering additional insureds, and that they're term. It's temporary. It doesn't last forever. Even if I have a permanent policy, any riders are going to be temporary. All right, cost of living. This is also a rider. So I'd have to buy it extra if I wanted it. And what this does is it prevents against inflation. So let's talk about inflation for a minute. My sister asked my grandma one time, what's the biggest difference between you were a kid versus like today with your granddaughter here? Like and great grandma, actually she asked my grandma. So to my niece, it was my great grandma. And she's like, what's the difference? And it wasn't technology. It wasn't TV. It wasn't internet. It wasn't anything. She said, well, when I was younger, I could buy a loaf of bread for like 5 cents. And now you have to spend $5 to get a decent loaf of bread. That's inflation. The bread is the same. The bread didn't change. It's dough and eggs and flour, right? It didn't change. The bread is the same. But you need more money to buy that bread than you did before. That's what inflation is that your value of your money is not as valuable as it was before. Like $1 back then was like $100 today. You were able to use less money to get the same thing. So let's say you buy life insurance today, but you don't die until 20 years from now. And the money that you need to pay out. So let's say you bought insurance so that you can, if you die, you can pay your college, your kids' college. And you calculate, well, according to today's prices, sending my kid to college would be, this much money. But in 20 years from now, it can be significantly different. And if your insurance stays stagnant, if it's the same amount of money, it may not be enough to cover the costs that you intended. Even not just college. Let's say that you buy the policy when you just got married, and at the time you're thinking of just your spouse and just the mortgage. But then you end up having some children. Now you've got, multiple children that you have to feed. You've got to pay for all their food, their clothes, and their doctor visits and all this stuff. And you end up dying 10 years later. Your spouse has these young children and all this money that they need to keep the children fed and healthy and happy. and the cost of living has gone up and there's not enough. So by buying this rider, you're making it so that if you die and the cost of living has gone up, the policy will automatically increase to match inflation. And the government keeps track of inflation. You can look it up right now. You can know how much inflation has incurred over time. So what the insurance company will do, and you don't need to know this, you don't need to know the math of this, you don't need to do any equations. They'll say, okay, this was your policy benefit. Inflation has increased, 2%. We're going to increase your policy benefit 2%, and that's what we'll pay out. And again, there is no evidence of insurability. It just automatically increases the death benefit when you die if inflation has incurred. There is technically deflation, where money, the value of money goes up, but that rarely, if ever actually happens at this point. There's always inflation. So this again is a rider. You'd have to pay extra money for that. And the key thing is it allows the policy benefits to increase based on inflation. So when you die, they calculate inflation at that point, increase your policy benefits so that your beneficiary, the people left behind, have enough money to adequately take care of everything. And that is cost of living. Okay. All right, next up, we have the entire contract. Now, this is a provision. We're kind of getting into provisions here. And again, it doesn't really matter in a sense, like it's not like they test you on what's a rider, what's a provision, but it is helpful to know what's a rider, to know like what costs extra money. But now we're moving into some provisions. And if we see another rider, I'll tell you if it's a rider. So entire contract. The entire contract is known as the policy plus the application that was used to get the policy. And when you staple them together, they call that the entire contract. Now, sometimes though, and that's mainly the testable point, entire contract, policy plus app. The policy plus the application stapled together is known as, and the answer is entire contract. Or what makes up the entire contract? It's the policy plus the application stapled together. They don't always say stapled together, but sometimes they do, so I like to throw that in there. Now, sometimes they will drag out the definition of policy, and they'll say policy plus riders plus addendums, but ultimately, a rider and addendums are part of a policy. It's kind of like saying you've got a hamburger with lettuce and onions and pickles. They're extending out the definition of it, but ultimately you still got a hamburger. Okay. So whether they say policy plus application or they say policy plus riders plus addendums plus application, same, it's the entire contract. So the key thing is policy plus application, but don't be alarmed if they say policy plus riders plus addendums, then the application, it's all the same stuff. And that is the entire contract. And one of the weird questions that I have actually seen too is that nothing can be used to change the policy. Like no other document can be referred to in terms of how the policy pays out other than the application and the policy. Like, so for instance, when you buy a policy, you're like locking it in. And it's in it, and whatever is typed up in that policy is what it's going to be. If the insurance company says, you know what, we want to make a memo, and this memo says that we're going to change life insurance policies, they can't use that. They can't just make something up and say, well, now we're going to change your insurance. They can't do that. So that's what the entire contract is essentially protecting, is that nothing can be used to determine the payout of the policy other than the policy and the application used to get it. Those are the only two documents they can refer to when seeing how the policy pays out or the policy benefits, et cetera, et cetera. Now, the reason they throw the application in there is because we're going to learn something a little bit later, like misstatement of age or gender. That can affect the way the policy pays out. If you told them you were 25 and you were actually 35, and they find that out, it's going to change the way they pay you. And so that's why they can refer back to the application. But generally speaking, the policy is the main thing that will determine the coverages, but they get to refer back to that application to see what answers you put in. So the entire contract is known as the policy plus application. No other documents can be used to determine how the policy is paid out other than the policy plus the application. And then remember, riders and addendums are just simply parts of a policy. They're not separate from the policy. They're just different sections of the policy, if they're in there. If they drag it all out like a big definition, that's fine. David, honey, did you get my text message? David, do you see my text message? Can you check it, please? I want him to make bacon. We're gonna have a break here soon. I need a snack. Pregnancy got to be eaten all the time. Okay. All right. Next up is the insuring clause. This is also a provision. And this is a provision that you find in every single policy. And sometimes it's actually known as the insuring agreement. So you can see this as two ways. They'll say insuring a clause or insuring agreement. Same, tomato, tomato, clause, agreement, clause, same. So whether you see insuring clause or you see insuring agreement, same, okay? Now, this is what I like to call is the essence of the policy. Without the insuring agreement, there is no policy. There is no benefit. There's no contract. Like, it has to be in there in order for the contract to be valid. And in order for insurance to actually pay out, like, this is what makes, I don't want to say contract valid, because technically you just need four things: agreement, consideration, common parties, legal purpose, when it comes to the elements of an insurance contract or the elements of a legal contract. But without this, an insurance policy isn't an insurance policy. It has to have this in here. And the key thing is that this is known, added a little N in there. This is known as the promise to pay. This is where we find the promise that says, if the peril happens, if you die, because we're talking about life insurance, if you die, we will pay out. This is the section of the policy that says that. So it's known as the promise to pay, and it lists the parties to the contract. So parties are just the people involved in the contract. And that's generally going to be the insured and the insurer, or the owner, the insured, and the insurance company. There can be up to 3 people. And basically the insuring a clause is a little statement like this: this party, the insurer, promises to pay this party, the insured, if the covered peril were to occur. And what we notice about the insuring clause or the insuring agreement is we got P, P, P. They've got the P's. It's all about the P's. The only P that's missing here is premium. They don't talk about the premium in the insuring agreement. It's just not part of the equation. But the key thing is that this party promises to pay that party if the covered peril were to happen. And we are promising that. So it's the promise to pay if the peril were to happen. And these are the parties that agree to that. These are the parties that are involved in this. That is the insuring agreement, the insuring clause. Again, don't be alarmed if you see insuring clause or insuring agreement. Same. It's all the same. All right, next up, and again, please make sure you're asking if you have any, for any of you who are live on the boot camp, make sure you ask me any questions. All right, next up is the free look period. Now, this is a provision. You don't have to buy this extra. It's part of every policy. And sometimes this is called a right to return. I rarely, if ever, see that, but sometimes you see that, a right to return. But it's mostly called the free look period. What this is is a 10-day window, and technically some states do have longer free look periods, and you will find that in your state specific course and text, what the free look period is for your state. But it is generally a 10-day period of time that starts at policy delivery and allows the insured to review the policy and return it for a full refund if they don't want it. Any money that they paid, all of it would be returned back to them if they decide during the free look that they don't want it. The most testable point is that it starts at policy delivery, not the effective date. So this is key here to understand. The effective date is the start date of the coverage. And when you learn in the completing the application or the field underwriting chapter, it's possible if the person paid the premium up front, like before the insurance company even decided if they were willing to insure them or not, the customer can pay on a conditional receipt, which basically says, we're paying the premium now in hopes that you will issue the policy. And if we pay the premium now, we want the policy to start now. We know that you still need time to do underwriting and confirm that you're going to issue it or not. But if you do decide to issue it, we want you to issue it on the day we paid. And that's a conditional receipt. So it's possible, for instance, that like, if you were to do a conditional receipt. So let's say you did a conditional receipt. This is the date of the app. So you filled out the application at this point. They take 2 weeks to do underwriting. And then they decide they are going to go ahead and issue, but the effective date will be that date. Then they mail it to you. That's going to take a couple of days. And then it is delivered. At this point, it's delivered. This is why the free look period starts at delivery, not the effective date, not the issue date, but the date that it's delivered, because the free look period is a time for you to review the policy. How can you review it if it's in the mail? How can you review it if they're still deciding on it? You can't do that until you have it in your hands. So the key thing about the free look period is it starts at delivery. And one of the things that we, so delivered is the free look begins. Free look begins. They may ask you questions with dates on it. They'll say something like, the effective date of the policy was July 25th. It was mailed to the customer and they received it on July 28th. When does the free look period begin? And you'd have to pick July 28th, the date of delivery. So not the date that they mailed it, not the date that they effective issued it, and not the date of the conditional receipt. It has to be the date of delivery, the date that it's in their hands. And then at that point, they have 10 days to look it over. And if they decide that they don't want it, they can return it for a full refund. If they go after the 10 days, so let's say they decide, let's say the effective date was like May 1st. And the issue date was May 14th. So it took them 2 weeks to decide, but they make May 1st the effective date because they paid a conditional receipt. They paid in advance, basically, in hopes that the insurer would issue it. And the insurer decided to issue it, so they put the effective date as May 1st. Then it's in the mail let's say it's in the mail for like 3 days. And so the date of delivery would be May 17th. And that means my free look period is going to be until the 27th. Okay. Let's say I decide to cancel on the 30th. None of this time will be refunded. They were covering me between May 1st and May 30th, and none of that will get refunded. They will return the premium going forward. Like if I paid the year in advance, they will cancel it as of the 30th and refund me any money from the 30th until the next May. But they will not give me any money back during the time that they covered me. So in order to get all your money back, you have to cancel it during the free look period. If you wait after the free look period, they will refund you for any days paid in advance, but they will not refund you for the time before because they were technically covering you. And if anything were to happen in between that time zone, they would pay the claim. So again, the key thing is 10 days to check your state, and then starts at policy delivery, not the effective date, and that they can return it for a full refund. All right. Next one is consideration. And this is also a provision. And this one is also an element of a legal contract, So this usually comes from the completing the application or the field underwriting chapter, or potentially general insurance, depending on your state. But there are 4 elements that make a contract legal, and consideration is basically one of those elements. So this is potentially a double dip question where they can ask you about this twice as often because it comes in 2 sections. One, it comes in the elements of a legal contract, completing the application chapter, and it will come from the provisions chapter as well. So it's very important is what I'm trying to say. You want to know this one really well. So the first thing you need to know is that both parties must bring value. That's what consideration means. Consideration means you bring value to me, I bring value to you. So when you think about parties in the contract, you have the insured and you have the insurer. Both parties must bring value to the other party. If I'm gonna, like, even in this like element of a legal contract is a rental agreement, a job offer, right? It doesn't have to be an insurance contract. An insurance contract needs to be a legal contract, so it must have all 4 elements. But any legal contract has to have consideration. So when we think of like a rental agreement, for instance, the tenant is bringing the value of rent money, and the landlord is bringing value of a dwelling, a house to live in. Both parties have to bring value to the other party in any legal contract. When it comes to the insurance contract, they have the specific values for what that means. So 1, consideration, both parties must bring value. I have to bring value to me, or I have to bring value to you, you have to bring value to me. We have to bring value to each other. Why else would we sign a contract? If you're getting no value out of it, you wouldn't sign a contract, okay? So knowing the definition is key. Consideration says both parties must bring value to the other party. And think of the word consideration. I consider what you want, you consider what I want. We consider each other. We are considerate of each other. Then you need to know what that value is. Now, they will not ask you what value do both parties bring, ? They don't ask you that. They will ask you what is consideration on the side of the insured, or what is consideration on the side of the insured. That's how they will ask you that. So the word value will come in on the definition of consideration, but then when they ask you what value does the insured bring, they don't use the word value. They will say, what is consideration on the side of the insured, or what is consideration on the side of the insurer. So you need to be prepared to see it that way. So this is legitimately a test question. What is consideration on the side of the insured? What is consideration on the side of the insurer? And your other test question is, what is consideration? Both parties must bring value to the other party, okay? Now, let's go into it. What does the insured bring of value to the insurance company? So why would an insurance company be willing to offer a policy to a person? It's because of their risks that they are bringing and wanting to transfer, the risk of dying, the risk of crashing our car, the risk of a medical bill. We transfer that to the insurance company and we're willing to pay them for it. So that's valuable to them. Our risks are valuable to them, and the premium that we're willing to pay. So consideration on the side of the insured, remember insured, you have ED, that person is dependent, the insured is dependent upon the insurer, the ER, who you go to in an emergency. So that's like a little memory trick to make sure you remember the difference between the insured and the insurer. The insured is the customer, the applicant, the person wanting or buying insurance. The insurer is the company offering it. So consideration on the side of the insured is the application of our risks and the premium we're willing to pay to transfer those risks to the insurance company. What is consideration on the side of the insurer? On the side of the insurer, it's going to be promised to pay, and it's promised to pay a claim. They won't use a claim, but that's to help you understand what we're saying. Is that promised? They'll just say, what is consideration on the side of the insurer? Promise to pay, period. That's it. But it's ultimately promised to pay a claim. So we promise that if you die, we will pay the claim. We promise that if you get sick, we will pay the medical bill. We promise that if you crash your car, we will pay to fix it. So again, this is a highly testable point because it can come from two different places. One, you need to know the definition. Consideration is both parties must bring value to the other party. And then they will ask you what that value is, but they don't word it that way. They'll say, what is consideration on the side of the insured? App plus premium. What is consideration on the side of the insurer? Promise to pay a claim. Okay. Highly, highly testable point. All right, the next thing that we got is owner's rights, and this is a provision, not a rider. And owner's rights are the rights of the person who got the policy. Now, it's important to understand the owner isn't necessarily the insured. If a wife buys a policy on her husband, the wife is the owner and her husband is the insured. But if you buy a policy on yourself, you are the owner and the insured. So the owner can be separate from the insured. But a key thing is that the policy owner must have insurable interest at the time of application, and they are responsible to pay the premium. So the owner of the policy, if a wife is going to buy insurance on her husband, that is insurable interest, wife and husband. But like if I wanted to buy an insurance policy on Haley, I can't do that. I don't have any connection to Haley. I'm not dependent upon her income. She's not dependent upon mine. We're not family. I'm not, responsible for her in any form or fashion. You can't buy insurance on someone unless you have a connection to them, blood, business, or money. So insurable interest is you have to have blood, business, or money. And when we say business, yeah, you bought a ticket to be here today, but that doesn't mean that we have business together. That when we say business, we mean like a partnership, a business partnership. I own a business with my friend. The two of us are business partners. We could buy insurance on each other because if one of us were to die, it would impact the business. And then money, when it comes to insurable interest, think about like a wife or any spouse can be dependent upon their other spouse's income. Like in our household, the major income is mine. So like David is dependent upon my income. He is financially invested in me as well as the blood. Now we're not blood related, but blood also means marriage. So blood, business, or money is insurable interest. And whoever the owner is has to have insurable interest in the person that they're buying insurance on. You're not supposed to buy insurance on a stranger. That's just weird. Okay. Because if a stranger does buy insurance on you, that stranger is going to want you to die so that you get a payout. You want a person to buy insurance on you who wants you to live forever, not have you die so they can get a payout. So that's a key thing about the owner is that the owner must have insurable interest at the time of application. Now, this is crazy too. Time of application is key. You can be married, buy an insurance policy on each other, get a divorce, and it doesn't matter. The policy is, as long as the premium's paid, like my sister still has a policy on her ex-husband. And if he were to die, she can get paid out. And she would be owed that money, no doubt. Well, based on, what happened in their relationship. But technically, you only need it at the time of application. So it is possible to buy insurance on your spouse, get a divorce, and 20 years later, if they die, you can get paid out as long as a policy premium was paid. As long as it's still active, you can get a policy payout on that. Okay, now, what are the ownership rights? We talked about the owner, that the owner has to have insurable interest at the time of application, and the owner is responsible to pay the premium. So what are the owner's rights? What rights do they have to the policy? The first one is that they get to pick and change the beneficiary. So the beneficiary is the person who gets the payout. The person who gets the money when the insured dies. And you do want to know that definition. It's the person who gets the money when the insured dies, and the owner gets to pick them. Now, the owner can pick themselves. Like if a wife does buy a policy on her husband, she can list herself as a beneficiary. That's her right to do. She gets to choose who the beneficiary is. So you can certainly name yourself as the beneficiary if you're not the insured. But you can also change them. So you say, I want to change it to someone else. I want to pick someone else. And that's the right of the owner to be able to do that. But we are going to talk about certain beneficiaries that impact ownership rights. So we'll talk about that in a minute. The owner has the right of choosing the settlement option. So the settlement option is basically the payout. And we'll get into this later, but there's different ways that the insurance could pay out. It could pay out one big lump sum. It could pay out in monthly installments. There's a few different ways that insurance policies can pay out premium or pay out the death benefit. I'm sorry, not pay out premium, pay out the death benefit. So, and the owner has the right to do that. So for instance, most people would just assume that you get the full lump sum. And that's probably the most common way that life insurance pays out is one big lump sum. But there are cases and instances where you don't necessarily want to do that. Like for instance, let's say you have children and the money. Now you generally don't list children as beneficiaries because they're not allowed to receive the money. If you did list your child as a beneficiary, the money would actually go into a trust fund and it would be managed by a lawyer, or the guardian of that child would take the money because it can't legally be paid out to children. So never list your children as your beneficiary. If you want your children to be your beneficiary, you need to set up a trust fund or have a person designated to handle it, because you need to have it set up better. Don't just name your children. It's not going to work out well. You want to make sure you have a trust fund set up. But so if you do want it to pay your children, though, you don't want to like give your 18-year-old, $1 million. They're probably not going to spend it very well. You want to make sure you pace it out. So you can choose that they receive monthly installments instead of one lump sum. Like that's one of the options. Or in the case of my gambling grandma. So I've got a grandma who's addicted to gambling. And we would not want her to have the lump sum because she would blow it all. When my husband died, I'm going to go to the casino and, play out my tears, we wouldn't want her to do that. So grandpa, if he buys life insurance, he can set up monthly payments to grandma instead of allowing her to have one lump sum. So the owner gets to choose. Now, if they don't choose, if they don't make a decision, the beneficiary will choose upon the death. So it's not that the owners always choose, it's that they have the right to choose, that they can choose if they want to. The next one is receiving the living benefits. So on life insurance policies, living benefits are when the money pays out while the insured is still alive. Now, living benefits are generally going to be like you're dying. We know you're going to die. Like if you're terminally ill and you need money for hospice, you can basically cash in your life insurance early. If you need a kidney transplant or you're going to die, you can use your life insurance early. So living benefits, and we'll go over that one in more detail because it is a testable point. But the owner is the one who would receive the payout of any living benefits that are available. And the other owning right is assigning the policy. Assigning means to either give it away or to sell it. You assign it to someone else. I'm giving it to you. I'm selling it to you. So the owner is the one who has the right to do that. And you can sell your insurance. You can absolutely sell your insurance to someone else. This was actually a lot more common before living benefits were a thing. Nowadays, most policies are automatically issued with living benefits. You don't even have to pay extra for them. It's just automatically included. But before living benefits existed, like if you knew you were going to die, I mean, you had no living benefits available because it didn't always exist. You could sell your life insurance policy to someone. You could go, hey, I'm about to die. My life insurance policy is $100,000. I will sell it to you for 60. So you give me 60 cash right now. And when I die, you will get all 100,000. So you'll get paid for the 60 you paid me, plus you'll get another 40 grand on top. And you were allowed to do that. You can do that even today. So you are allowed to sell your insurance. And in fact, there are companies like J.G. Wentworth, who is set up to do that. So there are legitimate companies that can buy your life insurance from you. They, of course, will check to see, you don't always have to necessarily be terminally ill. If you are terminally ill, they will call that a viatical settlement. Viatical, you may see that in your studies. Not a super highly tested topic, but just think viatical vitals. The key thing about viatical is that your vitals are going down. You are dying. You are definitely dying when it's a viatical settlement. A life settlement simply just means that you're selling your insurance to someone else, but you're not necessarily dying. But anyone who is buying it is going to assess, because they're going to have to take over the premium, right? If you sign the policy to someone else, you sell it to someone else, you give it away, the person who now takes it becomes the owner, and the owner is responsible to pay the premium. So if you say, buy my life insurance policy from me, but you're going to have to pay the premium for the next 30 years while I'm still alive, it might not benefit them to do that. So usually you've got to be older or close to death in some form or fashion for someone to want to buy it. Okay, so those are ownership rights. Okay, so now we're going to go into beneficiaries, which really play into owner rights. Okay, so we're going to dissect each one of these, but I wanted to just briefly define them very quickly. So there are a couple different beneficiary designations. You have primary and contingent, and you have revocable and irrevocable. It's not, you can be primary and revocable. You can be contingent and revocable. You can be primary and irrevocable. You can be contingent and irrevocable. You're basically both. You're one of these and you're one of these. The reason I'm stressing that is because I had an argument with a guy one time, because he was so mad he got a test question wrong. And we'll talk more about that. But you want to know, primary contingent is about who is paid first or second. Now, technically, you can have two primaries. Like on one of my life insurance policies, I have 50% to one sister, 50% to another. You can do that. But for the purposes of the exam, they vote primary is first, contingent is second. Primary first, contingent is second. That's the testable point there. Then with revocable, irrevocable, it's who can be removed or changed. So can you change that beneficiary, or are you not allowed to change that beneficiary? Okay. So let's first get into primary and contingent. So primary is the first person to receive the payout if still alive when the insured dies. So the primary does still have to be alive for the life insurance to pay out to them. If the primary is already dead, they're not going to receive the money. So they have to still be alive when the insured dies. Contingent is the second person to receive the payout if the primary dies before the insured. So like if my life insurance policy pays out to my oldest sister, primary, but she dies before I do, when I die, it would pay out to the contingent, the secondary person. So the contingent only receives the money if the primary is dead before the insured or at the same time as the insured, which we'll talk about. Then we have revocable, irrevocable. And I put like this is it's ugly, and it ruins my beautiful PowerPoint, but it's so important that you remember irrevocable requires consent, irrevocable requires consent, irrevocable requires consent. That is the most testable point of this. So let's talk about this. Revocable is a beneficiary that can be changed to someone else at any time by the owner. Let's say you list your sister, you get mad at her one day. I'm taking you off as a beneficiary. I'm going to change it to the other sister. You get mad at her. F you. I'm going to change it to my best friend. You can change it any day that you want if they are revocable into any other person that you want. So revocable means changeable. Revocable is changeable, and you don't need anyone's permission. You can just simply change it. Irrevocable is a beneficiary that cannot be changed. They cannot be changed unless they give written consent to remove their name. They have to sign a piece of paper that says, yes, you can take me off as a beneficiary and change it to someone else. So irrevocable requires consent. That beneficiary has to say, yes, I am willing for you to take my name off as a beneficiary. I'm willing to give up the death payment to someone else, and I am signing a piece of paper. Now, this is most common in the cases of like when you have spouses and they get a divorce and they have children, the wife may still, I want to be irrevocable so that if you die, I can take care of our kids and you can't change me without my permission. So you can do that. And a key thing is, this is where I got into an argument with the guy, because this was the test question. It said a wife wants to put her husband as the beneficiary, and she wants to retain all rights of ownership. And he was arguing with me that the husband, and the answer choices were A, B, C, D: primary, contingent, revocable, irrevocable. And he was like, the answer is primary. She wants her husband to be beneficiary. He's primary. I said, you're right. He is primary, but that's not what the question is asking. The question is asking that she wants to retain all rights of ownership, which means being able to change the beneficiary. So her husband, sure, yeah, he's listed as primary, sure, no problem. But the answer to this question is that she needs to list him as revocable. In order for her to retain all rights of ownership, he needs to be revocable, changeable. Sure, primary, yeah, but that's not the test question. So he was arguing, he was like blue, and he's like so mad. And he's like, it's primary, it's primary. I'm like, yeah, he is primary, sure. But the key phrase of that question is she wanted to maintain all ownership rights. And that's why I was saying that it's not, I'm either primary or contingent or revocable or irrevocable. I can be primary and revocable. I can be primary and irrevocable. I could be contingent and revocable. I could be contingent and irrevocable. You're one of these and you're one of these. You could be both of these, okay? And in order to retain all rights of ownership, you need the owner needs to list all beneficiaries as revocable, changeable, because you lose the ownership right if the beneficiary is irrevocable, because that beneficiary requires consent. They must sign a paper that says you can take them off. Okay, so those are your beneficiary designations. And again, a key thing is, I don't have a slide here on it, but it is generally a bad idea to put minors as beneficiaries because they can't legally receive the money. It would be put into a trust fund run by a lawyer if you don't have anyone else picked out. And the other thing is like, I was watching a movie one time. It had Billy Bob Thornton in it. And there was like a kid who was like disabled, and he had a ton of money coming to him because his parents were very wealthy and his parents had died. And so all of this money goes into his trust fund. But the law says whoever the guardian of that child is also gets access to that money. So in this movie, Billy Bob Thornton and the other woman were like fighting to be the guardian so they could get all the money, right? So you got to be careful if you don't establish who the guardian is, if you don't establish the rules of the trust fund, some person, and I know I've seen some crazy family members, like you can have a very vicious grandma who's like, oh, give those kids to me. Oh, the parents died, give the kids to me. Let me have all the money, It's possible that people do that. So if you just list your children, it's open to anyone who will claim guardianship of your kids. You want to set up an actual trust fund with rules that you set into place. Like you can set a rule that says whoever the guardian is only allowed to take this much money. And because they are allowed to take money to raise the kid, right? You're allowed to access the money as the guardian. So you want to make sure you set it up officially. All this talking, I'm losing my voice. We're at the bar last night for a birthday party and they're like, sing karaoke. I was like, I gotta save this. I gotta save this voice for tomorrow, the next 2 days. All right, next one that goes along with common disaster. And then after this, we're gonna go and take a break. I can smell the bacon cooking, so I know he's got it almost done. All right, this one also goes into play with beneficiaries. So this is, so common disaster is basically saying that the primary and insured are in the same accident, same deadly accident, to be more specific. Okay, so let's look at a scenario, okay? And I made this up so I can help people visualize what this looks like. So first, what is common disaster? It's a safety measure to make sure the money goes to who it's truly intended to go to when the insured and the primary beneficiary die at the same time-ish. I put time-ish because technically they could die separate from each other, but because of the same accident. Like if 2 people are in a car accident, one dies on the scene, one dies later at the hospital. They died from the same thing, but not necessarily at the same time. So I put time-ish to signify that. So let's say in this scenario, we have a husband and a wife, and they have a young child together. And let's say that the wife has a policy with the husband as primary to be able to take care of their young child. So in her mind, she's like, I have a young child. If I die, I want to make sure that my husband will have enough money to take care of my child if I were to die. So she sets up a policy, lists her husband as beneficiary. Now, the husband also has adult children from a prior marriage. Okay, so let's look at how this could play out. If the wife dies first, so they're in a car accident together, the kid is at home with the babysitter, the mom and the dad are in a car together out to see a movie, they both crash in the accident, and the wife dies at the scene. So the wife dies first. The money, her policy would pay out to her husband, okay? But he dies shortly after. The proceeds of the wife policy will then go to the husband's estate. So if without the common, this is a scenario without the common disaster clause. Like this is why the common disaster clause exists, is so that this scenario doesn't happen, okay? So a wife dies, the money goes to the primary. The primary dies shortly after she did from the same accident. Now all of her money from her insurance goes to him, and now it goes to her husband's estate. And his older kids can try and get that money. They can make a claim to that money because it's in their father's estate. And as his children, they can make a claim to it. And so they can get that money when it was truly meant for the young child's well-being. Like imagine if these are angry, bitter, older adult children who hate their husband's wife, right? Like that's possible. You can have a situation where that happens, okay? And they're like, oh, all of her life insurance money is now in his estate and we can make a claim against it. To prevent that from happening, they have what's called the common disaster clause. And the common disaster basically allows the insurer to not pay the primary beneficiary who died. Because like if they died, legally speaking, if we go back, the first person to receive the payout if still alive when the insured dies. So as long as the primary lived one more minute, but beyond the insured, they would get the money. So to prevent situations like this, though, the common disaster allows the insurance to list the primary as dying first, even if he died second. And usually it's like a 2-week window. Like they can't drag it out forever. But so like we have the car accident, wife dies at the scene, husband is in the hospital for a week before he dies. Because they have the common disaster, they're able to say the money is not going to go to the dead husband. It's going to go to the wife's sister, who's going to take care of the young child. So it's a safety measure to make sure that the money goes to who it's truly intended to go to, and not go to a dead person's estate that other people can then make a claim on the money. Okay, so with that, we're going to pause the record. Does anybody have any questions right now? Okay, I'm going to go ahead.
Good.
Perfect. Okay, I'm going to pause this recording. All right, so we came back from our lunch. We're moving right along with our provisions, options, riders, exclusions. They're kind of all over the place, but again, it's not crucial for you to know what's a rider, what's a provision. Although the one important thing with riders is knowing that they do cost extra money. So we made sure to write everything down that was a rider. And at this point, we're pretty much moving into provisions. And we're now on mode of premium payment. So the first thing you want to know about mode is that it's how often someone pays their premium. So you can pay monthly, you can pay quarterly, which is 4 times a year. You can pay semi-annually, which is twice a year, and you can pay yearly, which is once a year. And all of those are mode. So mode is how often, how frequently the insured pays the premium. And I like to say, the more you pay, the more you pay. What we're saying there is that it costs you to split your payments up. So life insurance is technically calculated for a 1-year premium. Like that's how they assume, like when they determine everything, they determine your risk factors, they determine your chances of death when you buy your life insurance, and it's all based on paying one time. When you decide to pay monthly, you're technically dividing that up. You're splitting up the payments and you're financing the premium. They literally consider it financing. When you're on a payment plan, you're financing it because technically you should have paid it all up front at once. That's how it's set to be. So when you break it up, you're financing it. Well, what happens when you finance something? You've got to pay interest. Now, they're not going to call it interest, okay? They're not going to say that. What they are going to say, though, is that when you pay monthly, you pay more. When you pay monthly, you pay more. Your monthly payment may be $9, which seems like very little money, but 9 times 12 is going to cost more than if you had just paid it once. Okay. So mode is how often we pay. And the more you pay, the more you pay. The more you split up the payment, the more you will pay overall, because instead of them mailing you 1 bill for the year, they got to mail you 12 bills for the year. That's 11 extra letters, 11 extra billing cycles, 11 extra stamps in the mail that they've sent you, 11 extra emails. So you're paying for that. So the more you split up the payment, the more you will pay. Now, if you were to split it up quarterly and pay 4 times, it will be a little bit cheaper than monthly overall, right? So when I say monthly is more expensive, I'm saying the overall premium when you add it all up. So if we were to do like an example here, so like, let's say if you did monthly, you would be paying, let's say you pay $10 a month. So you're looking at 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And that would be a total of 120. If you were to pay yearly, they would just charge you 100 and you would pay that one time. So monthly is cheaper each month, each single payment, But when you add it all together, it's 120 versus 100. And that extra $20 is because they had to split it up every time that you paid. So you're paying extra money for the stamp, extra money that they had to do more billing cycles. So that's important to know and understand, because here's where the test questions come in. They're going to say Mary had a policy that she was paying monthly premiums on. She decided to switch to yearly payments. What can she expect to happen to her premium? And the answer is it's going to go down. When you go from monthly to yearly, when you go from paying 12 separate times to paying one time, your premium goes down. You pay less overall. You pay less overall. If they ask you a question that says Mary was paying yearly and then she decided to switch to monthly, what can she expect to happen? It'll actually be higher overall premium. She's going to be paying more premium, even though each individual payment is less, $10 versus $100, but you're paying that $10 12 times and you only pay that $100 once. So mode is how often you pay, and you can pay, and they don't really ask too much about the different modes. Monthly and yearly tend to be the two main ones they talk about, but you technically have monthly 12 payments, quarterly 4 payments, semi-annually 2 payments, and yearly 1 payment. And quarterly would be cheaper overall versus monthly, because 12 versus 4, you're paying it a lot less, but you're still breaking it up. But like quarterly will still be more than yearly. The overall, when I say more, I mean the overall premium when it's all added up together. And the test questions will come in by giving you real life scenarios. So-and-so had a policy, they were paying on it monthly, they decided to switch to yearly. What can they expect? Lower overall premium. So-and-so had a yearly policy, they decided to switch to monthly. What can they expect? Higher overall premium. And that goes right along into grace period, although with life insurance, it doesn't have a huge impact. With health insurance, the mode of premium payment highly impacts your grace period. With life insurance, the grace period is always just 31 days. So what is the grace period? The grace period is the time the insured can be late on their payment and still covered. So if my payment is due on March 1st and I don't pay it, and then I die on March 15th, they would still pay my beneficiary my death benefit. I am still covered during that time. And the grace period, so is if I miss my payment, I immediately go into the grace period. And on life insurance, it will last for 31 days. They never make you pick a number. I think it just depends on the month, right? If the month is 30 days or the month is 31 days. So you could think of it as a month, but they'll always put it as 31 days. So in that 31 days of me missing my payment, I am still covered. And if I die, my beneficiary will still receive the money. If I fail to pay and I die on day 32, my beneficiary will not receive the debt. Well, on a whole life, they could still, but not on a term life. But don't worry about that. We'll talk about what happens when you have a whole life policy. The key thing is they won't ask you about grace period versus whole versus term. I kind of went on a tangent there. That's not necessary. What you want to focus on the grace period is the definition, the time the insured can be late on their payment and still be covered. And that for life insurance, the grace period is 31 days. For health insurance, and we'll talk about this tomorrow if you're in the health boot camp, for health, the grace period will depend upon the mode of premium payment. So with health, they'll say, well, do you pay weekly, monthly, or yearly? And that will determine your grace period. And so I like to just point that out for those of you who are taking both, to be consciously aware that your grace period is different between life and health. If you're life only, 31 days, you're solid. Now, what will happen, just so you know, and this isn't really a highly testable point, but just in case you see it, let's say that you miss your payment, right? So you miss your payment. And then you fall into the grace period. And let's say that your payment that you missed is $100. And let's say that your death benefit is $10,000. Okay. If you were to die anytime between here and here, if you were to die, what they will do is they will say, okay, your death benefit is $10,000 and we'll pay that to you because you're in the grace period, but we are going to subtract the $100 payment that you missed. So they simply just take it out of the death benefit. They pay themselves for the missed premium, and then they'll send your beneficiary the rest of the money, which I think that would be what, $9,900. Yeah. So they simply subtract your missed payment from the death benefit amount, and they'll pay you that difference. And they will only do it during after the grace period. If you were to go after the grace period, there will be no death benefit. Okay. Whole life a little bit different, but we won't talk about that. Don't worry about that. They won't go into that too much. With whole life, you actually have savings in there. Technically, if you run out of money in your whole life, though, this would work. Okay. All right, makes sense? Anybody have any questions? Okay. Again, you can always add, don't wait for me to ask. If you have a question, just jump in at any point. You can put it in the chat box or say it out loud, but you have the ability to ask questions. Use that to your advantage if you have any. I failed math. I went to college to get my education degree, and I was going to teach social studies. And they're like, well, you still need to take a math class. And I was like, why? I hate math. There's no reason I should have to take a math class when I'm teaching social studies. They said everyone with a college degree has to have one math class. And I'm like, what? And I failed it, and I failed it. And I was like, I'm going to quit my whole career choice because I can't pass this one math class. And then someone's like, well, are you asking the teacher questions? I'm like, no, because that makes me feel dumb. If I don't know it, then I just feel dumb. And that's a side effect of school where, you know, they make us feel dumb or silly for asking questions sometimes, depending on your teacher. But I started asking questions and I was able to pass. I got a C. C's get degrees, 70%. That's all we need. But don't hesitate to ask. There's no, like, in my opinion, there's no such thing as a dumb question. Ask. All right, next up is just understanding the difference between level or flexible premium. If you have a level premium, it simply means it never changes. If it's $10 in the first month, it'll be $10 in the last month and $10 in the middle. It'll always be $10. The premium will never change if it is level. So level just means always the same. Level premium, always the same amount of money. If it is flexible, this means that the premium can be different. It could be lesser or greater amounts can be paid. And there are policies that are like term and whole are always level. It's going to be universal that is going to be flexible. And then there's also a policy called adjustable life, and that one can be flexible as well. But the two main ones, like I was talking earlier with Haley, when you're learning about types of life, which will be the next section we're going to cover in our live boot camp today, is we'll talk about all the policies because we'll have time. There are people always ask, but I need to know. I'm like, well, mostly, really, honestly, if you know term versus whole, and you're really good at provisions, you can pass your exam. I'm not saying they won't ask you about universal or they won't ask you about adjustable life, but the test really favors term versus whole. So if you can learn all about term and all about whole, and you're really confident in that, you can be able to pass the types of life section. But I will be covering universal and variable today, just to give you some peace of mind that you have that knowledge so that you can secure more points in that section. But term versus whole is the main one, and that is always level premium. All right, reinstatement. So reinstatement and this is also, and by the way, I told you I was going to tell you, but, like, so entire contract is also health. So if you're studying the health exam, entire contract is one of those provisions. Insuring clause, you will also find that on health as well. Free look period, you will also find that on health. So this is where they like double dip. So if you are taking the life and health exam, I want to point out the ones to you that are on both because they're double dippers. They're going to show up not only in the life section, but in the health section. Consideration is also health. And again, you're going to get a copy of these notes with all my drawings. So you'll have them labeled as health. Owner's rights is not part of health. Beneficiary designations. The only one with health is this will be on health, is they really emphasize the revocable, irrevocable. That one will show up on health as well. And then the grace period will also be on health, but this will have different times or different lengths. So it's important to be aware of that. Level flexible premium, that's not talked about in health, but reinstatement is. So reinstatement is also available on health, but it's kind of different rules. And so you want to pay attention to that. And again, that will be taught tomorrow in the live bootcamp section. Okay, so what is reinstatement? Reinstatement is, it allows the insured to get their policy back if it was canceled due to non-payment. Okay, so if you had a policy, so let's say you had a life insurance policy and you're paying on it, no problem, everything's fine. But then you get to a point where you run out of money and you're like, I can't afford this anymore. And so it lapses due to non-payment. Then a year later, you're like, I'm in a better place financially. I want to get my life insurance back. You can call them up and say, I want my life insurance back. And they'll say, okay, one, you need to pay, and it's up to 3 years. So in my example, it's 1, but you can have up to 3. 1, they're going to say you got to pay all back due premium. So every premium payment that you missed, you're going to have to pay that back with interest, usually. And then they can make you undergo a medical exam or ask medical questions. And if you were to tell them, well, yeah, during this time I got sick, I got diagnosed with cancer or something, they can say no. So they can decide, you know what, never mind, we're not going to reinstate it. Thanks for trying, but no thanks. If your health is fine, then they can go ahead and reissue it. Now, the reason that they ask health questions is because who's likely to reinstate? Someone who got sick and is worried that they're going to die and want their insurance. So they can ask medical questions just to confirm that you're not already sick. There's not something currently wrong with you that's making you get your insurance back. And then there's one other thought I had. Doesn't matter. Okay, I don't know. I lost it. So reinstatement is good for up to 3. Oh, why? Okay, so some people ask, why not just get a new life insurance policy? That's a good question, but sometimes it is to your benefit, sometimes not. Because let's say that this was a policy that you bought when you were super young, super healthy. Remember, the younger you are, the healthier you are, the cheaper your premium. The older you are, the less healthy you are, the more expensive premium. So if I bought a policy when I was young and healthy, and let's say I was in my 20s and it was a super cheap premium, and then 10 years later, I'm 10 years older, maybe I've got some diagnoses that don't necessarily kill me, but they impact my overall health. And I were to try and get a new policy, the premium could be double or triple what my policy was when I was 20. So if you lapse on a policy, if you fail to make the premium and they end up canceling your insurance, reinstating it could be better than getting a new one because it comes with a much cheaper premium. It doesn't always work out that way, but it can. So that's a reason why some people may reinstate. I normally get that question, well, why wouldn't they just buy new life insurance? They can, certainly, if you're approved for it, if you're insurable, but you're probably going to pay a much higher premium than the one you had before. And that's why it makes sense to even do backdated premium to restart your old policy. And a key thing was canceled due to non-payment. So they call that a lapse. So if it lapses due to non-payment, they will cover it. Or, I mean, you can reinstate. But it was a different story if you were to call them and say, cancel my insurance, I don't want it anymore. If you were to call and cancel, if you called and terminated, and then you try to reinstate, that's not an option. Reinstatement is only an option if it lapsed due to non-payment. Okay, I shouldn't even use the word cancel. Let's just use the word lapse. If the policy was lapsed, lapsed due to non-payment, that's a much better way of saying that, just so that you have the right words for the exam. It is technically canceled due to non-payment. That's not a wrong way of saying it, but they will talk about it lapsing due to non-payment. All right. Next one is dividend and dividend options. So first, it's important to understand what a dividend is. And this goes back to if a company is stock versus mutual. And that's not necessarily a testable point on every state exam, but some state exams will ask you the difference between a stock company and a mutual company. For our purposes, a mutual insurer is the one that will give dividends to the policy owners. So what is a dividend? So when an insurance company has all of their insureds that they're insuring for the year, and they'll be like, okay, we're insuring all of you, and based on our numbers, our statistics, and our predictions, 20% of you are going to die, 20% of you are going to need to file a claim. In order to cover all of you, we need to collect this much premium from everybody. And so that's how they determine their premium. They look at how many people they're covering, the estimated amount of deaths, claims, whatever, make sure that they're collecting enough premium to cover that. And that's how they determine it. A dividend is when they overestimate it, or they just had a lot less claims than anticipated. So a dividend is when there is excess premium left over after all claims have been paid. So when they collected all this premium to be able to pay all these claims, but there weren't a lot of claims filed, any money left over is excess premium, and it's going to be paid to the owners of the company. And that goes back to if a company is a stock company or a mutual company. For our purposes, we're focused on a mutual company. A mutual insurer means that the policy owners, the people who paid the premium, are the owners of the company. So a mutual company is the only company that a policy owner can get a dividend. Okay, so a mutual insurer means the policy owners are the owners of the company. So in a mutual insurer, you will get a dividend if they have it. They don't always have dividends. They might spend exactly what they anticipated. They might spend more than they anticipated. And so they might have to dip into savings to pay the claims. So dividends only exist when there is extra money available. So one thing to know is that dividends are never guaranteed. That's a testable point. Dividends are never guaranteed. Dividends are never guaranteed. So there's no guarantee that you're going to get a dividend because they could potentially spend more money than they had available. Now, what we want to know a lot is dividend options. So this again is a mutual insurer, which means I paid premium. the insurance company basically collected more premium than it needed, and it's going to give it back to me. And these are my choices as to how I can receive the money back. So dividend options are when you are eligible for a dividend because there is excess premium left over. All the claims have been paid and there is extra money left over. Here are my ways to get my money back. Here's how I can receive my money back, the excess premium paid. In a mutual company, a dividend is known as a return of unused premium. You're just simply getting the premium back to you. So the first way is just cash. You're just going to get the dividend as cash. Okay, so like at USAA, because I worked there, so I had experience with that. We would just direct deposit into their check account. Here's your dividend. It's $50. Boom, it's in your checking account. You just give it to them as cash. And that's probably the more common way. The next way would be a reduction of premium. And this is where we say, okay, you got $50 back from last year's premium. We're just going to simply apply it to next year's bill and reduce it by that much. So it is basically just taking the cash and immediately paying it towards your next year's premium. So you can reduce your premium for the next year. The next option is known accumulation at interest. This is where the insurance company will actually save your dividend for you in a little savings account, and they will just keep putting your dividend in there every year, and they will let it earn interest. And I have seen at USAA, there was a few people who chose this, and every once in a while, I would need to go look at their account, and they could have 20 grand in there. Like, and it's like this cool secret little savings account that you don't think about because you just pay your insurance premium, You don't ever think about that money coming back to you. So when you choose accumulation at interest, the insurer just simply saves that money for you, lets it earn interest, and it just grows and grows and grows and grows over time. And then you can take it out as cash whenever you want, or you can use it for the next option, which we'll talk about. But the one thing about this one is making sure that you understand that on the interest that is built, you will have to pay taxes, but you pay taxes only on the interest, not on the actual dividend amount. So the dividend will earn interest while it's sitting in the account, but you will not pay taxes on the dividend money. You will only pay taxes on the interest that the dividend money earned. And I think the insurance company handles that for you. I think USAA did that. And that is a testable question. Taxes are owed. Sorry, got some edits in there. I'm not the best speller nor editor. Taxes are owed only on the interest of the accumulation at interest. All right, the next one is paid up option. And what this one is doing is it's accumulating at interest until it's enough to pay off all remaining premium. So like they know when you buy, I know car insurance is a little funky because it renews every 6 months, your premium can change. With life insurance, when you buy a policy, they know exactly how much premium you're going to pay by the time the policy is over. Like, because it's level premium, right? Like my term insurance is like $28 a month. If I wanted to pay that completely off, I would go $28 times how many months I have left. And that's exactly how much premium to fully pay off the policy. And so paid up option is basically calculating that and using your dividend to pay it off. So there's a difference. Like this one reduces your premium right away. Like you owe us, $200, you had a $20 dividend. You now owe us $180. This one is paying it off fully. You'll never have another premium payment due again, but you got to rack it up. It's not your first dividend won't be enough to do that. You've got to rack it up over time, and you got to earn that interest on there. So the paid up option is you're going to accumulate that interest until it's enough to pay off all the remaining premium. Once it's enough, they cash it out, pay off the premium. You don't owe another penny of premium after that. Paid up addition allows you to buy more insurance for the life of the policy or / increase the death benefit. So this is where you just buy extra insurance on top of what you have, and it stays forever until the end of the policy. Whereas the 1-year term only allows you to buy 1 year term insurance at a time. So like paid up additions, you're probably only going to be able to do like $1,000 at a time. Like it's pretty, you're adding just a little bit of insurance here and there. Like your dividend can be really small, like $20, $50, maybe $100. It's not to say dividends are these huge amounts of money. It just depends on if they overcharged in premium or if they just had very low claims. But dividend, don't ever expect a dividend to be this huge chunk of money. It's not. It's a relatively small amount. So when you take your $20, you might be able to convert that to like $1,000 extra of insurance. You're buying little chunks at a time. But if you were to buy 1 year term, you could take that $20 and turn it into a $30,000 policy because it'll end in 1 year. Whereas this $1,000 is forever until the end of the policy. So some people get confused by these two because they're like, well, aren't they the same? Not technically. The paid up additions is for the life of the policy. It'll stick through it forever. So you're buying little bits at a time. The 1 year term, you're buying one big chunk, but it only lasts for 1 year. And then after that, it goes away. The 1 year term option seems kind of silly to me. Like, why would you just buy one unless you like know you're going to die or you're getting older? It doesn't really seem to make a lot of sense to do that. So these are the dividend options. Okay. Now you do want to remember all of them. And the way to do that, funny enough, CRAPPO, crapo. I overpaid my premium, but they're sending it back to me. If you can figure out another word for that, that's fine. But I got crapo. And then you actually can combine it with settlement options. So we're kind of, let's see, those are dividend options. Later on, we're going to do settlement options. This is actually CLLIFF, cliff. So I like to say you're going to crapo your pants because you fell off a cliff. And that will help you remember dividend options and settlement options. And settlement options are how they pay out the policy, like how you receive the death benefit money. So that's a crapo. I crapo my pants because I fell off a cliff is my dividend and settlement options. Okay. All right. Okay, again, if you have any questions, let me know. I'm just going to assume everyone's good unless you put something in the chat box or say something out loud. All right, incontestability. Now, this is a pretty interesting thing. In that, ultimately, you might be able to get away with a lie, but not in the first 2 years. So incontestability is a 2-year period of time that the insurer is able to deny a claim if they discover an inaccuracy or a lie in the life insurance application. So remember earlier, we talked about entire contract, and I said only the policy itself and the application used to get the policy can be referred to or looked at when they're paying a claim. And this is why they include the application. Because for instance, let's say on your insurance application, it asks you, have you ever been diagnosed with cancer? And you say no. And then they give you the life insurance. And then 2 weeks later, you die of cancer. Well, you would have had cancer. Now, if you knew you had cancer and you put no, that means that you lied. You were inaccurate on your life insurance application, and they can deny paying the death benefit. If you didn't know you had cancer, then that's fine. But very rarely do people discover they have cancer, or, whatever, you know what I'm saying? So my point is whatever you put in the application, 2 years of that life insurance policy starting, if anything that kills you or happens to you, And they go, but wait a minute, in the application, she said this, or she didn't tell us about that, or whatever. They can deny a claim in that 2-year period. And in some states, I've seen 3 years, but it's generally 2 all across the board. So again, you always got to check your state numbers. Now, after that period is over, after the 2 years, the insurer cannot deny a claim for any reason, even a lie. So that's only true on life insurance, by the way, not health. So in health, you're going to learn this, but it's going to be called time limit on certain defenses. And they'll say that that's similar to incontestability. That's actually a test question on the health exam. So it is similar because it's both a 2-year period where they can deny a claim if they find out anything. But the key difference between life and health is that life you can lie, health you cannot. So like if you were to lie, if they said, have you ever had cancer, and you say no, as long as you live through 2 years without any problems, and then the two years and 1 day happens, and then you die of cancer, and they go, wait a minute, she told us she didn't have it, but she just died of it. It's too late. They're past the 2-year mark. They will pay the claim as normal, even for a lie. Health insurance says at any point you lied, if you lied, we can deny the claim. So that's a big difference between incontestability and time limit on certain defenses. Other than that, they're the same. 2-year period where the insurer is able to deny a claim if there's any inaccuracies in the application. Yeah, okay. And I'm going to skip actually to this one because they kind of go together. I'm going to move this one up. Next one is misstatement of age or gender. And this is where somebody put a different age or a different gender on their policy application, which could result in adjusting the policy benefits. The key thing in here, misstatement of age and gender, adjust. Misstatement of age and gender, adjust. Misstatement of age and gender, adjust. The key thing is knowing is that if a person misstated their age or misstated their gender, then they will simply adjust the policy benefits in accordance to the correct age, the correct gender. Another key thing about this is that incontestability has no effect on this, meaning if they find out that you're the wrong age or the wrong gender 1 year in, they'll adjust it. If they find out you're the wrong age, wrong gender 2 years in, they'll adjust it. They find out you're the wrong age, wrong gender 20 years in, they'll adjust it. There is no point in time that you can get away with giving them the wrong name or the wrong gender. Now, with this one, they don't, even if it was a lie or you purposely did it, they're just whatever it, and they simply adjust, okay? Apparently, back in the day, it was very common for men to say they were older, very common for women to say they were younger, and life insurance companies are like, oh my God, we'll adjust it when we find out. So, and what we mean by adjust, and this is not super highly tested, although it's more likely to show, they don't ask you about this on the health side, but on the life side, they may give you an example of this. So like, let's instance for say, get out of here. I don't know why you popped up. Okay. No, I don't want you. Okay, there we go. Sorry. There's things happening on my screen. Leave me alone. David is laughing at me. Okay, so let's say you want a $10,000 life insurance, okay? And let's say you have a 25-year-old versus a 35-year-old. A 25-year-old buying that may only need to pay $10 a month. But if you're 35, you're 10 years older, you may need to pay, $20 a month for that same $10,000, okay? So if you told them you were 25, but you're really 35, you only paid half the premium that you should have. So if they just, so you said you were 25, you're actually 35, and they get your death certificate and they see your true age, they're going to say, whoa, she told us she was 10 years younger than she actually was. She's only been paying half the premium she should have. So what they'll do is they'll say, well, it was a $10,000 benefit when you're 25, but since she's now dead and we can't collect any more premium from her, we're just going to drop her life insurance down to like, I don't know, maybe 6,000, whatever $10 for a 35-year-old would have gotten. That's what they'll drop the benefit down to. So if you're still alive and they catch it, they'll give you the opportunity to pay your missed premium. But if you're dead, they simply lower your death benefit. Now the reverse can happen too. Like, let's say you filled out your life insurance application and the underwriter transposed, you were 25, but they actually plugged in 52. Okay. So you've been paying this higher premium all this time. They will just refund you the overpaid premium. So when your age is different from what you said, if it's to your favor, where they messed up and they put you older than what you are and you've been overpaying, they'll refund your premium. When your age is listed younger than what you are, they will adjust your benefit and just simply lower the death amount that they pay you. So the key thing though is simply remember, misstatement of age and gender, adjust. Misstatement of age and gender, adjust. Misstatement of age and gender, adjust. And that's the key thing they'll test you on. What happens when someone misstated their age or gender? The insurance policy will adjust itself. It just adjusts, okay? And again, like I said, they don't really care too much about it. Once they discover it, they simply adjust it. They're not going to be like, oh my God, you lied to us. You're the wrong age. This is horrible. They just adjust it. And then in terms of gender, I know I've had some people ask this question. In terms of like trans folks, they can set up their life insurance for whatever is on their birth certificate. If they're unable to change it, if the state doesn't allow those laws, then they should fill out their application to their birth gender. But if they don't, it's ultimately, it's not going to ruin anything. They simply adjust it. So women generally are going to be a cheaper premium than men, because women live longer, because we nag men to death, right? So women live longer. Women are generally healthier overall, whereas men will die earlier, and men tend to have more health problems with all the bacon they eat. Mr. High cholesterol over there. So that can impact, right? So like a 25-year-old female compared to a 25-year-old male, she's going to pay a slightly lesser premium than the male would if they have same health, right? But again, adjust. When they find out you're the wrong age or gender, they adjust it. That's it. And it doesn't matter when they find out. 1 year in, 2 years in, 10 years in, 20 years in, doesn't matter. All right. Assignment. So, and this is on health as well. So let me put that on there again. I wanted to, for all of those who are taking both, this is on the health too. So like I said, there's a lot of provisions that double dip between the two, and you'll want to know those. Okay. All right. Assignments. So assignment, remember, assignment is a transfer of ownership. Transfer of ownership. So this is where you assign the policy to someone else. You give it to someone else. And there are two types of assignment. There is absolute, where it's a full and complete transfer of ownership to another person. So I own this life insurance. I assign it to you. You now own it. I can never get it back unless you decide to assign it back to me. Okay. So I completely lose all rights if I absolutely assign it to you. You absolutely lose all rights if you absolutely assign it to someone else. They take absolute power of it. It is absolutely theirs. You can't get it back unless they decide to give it back to you. Collateral, on the other hand, is a temporary transfer of rights usually in regard to a loan. So like, let's say I go to the bank and I'm like, I want to start a business and I need $10,000. And they're like, okay, we will do this for you, but we are worried you may die and that you won't pay the loan back. So we want a life insurance policy on you so that if you do die, we can pay the loan off. You can collaterally assign them as much life insurance as the loan. So let's say I have $100,000 of life insurance. I'm asking them for $10,000 to start my business. And they say you need to have life insurance. I can assign them $10,000 of my life insurance to match the loan. Now, as I make loan payments though, so will the collateral assignment match. Like the bank can never get, like if I paid off half of my loan, they're only gonna get $5,000. You're not gonna get the full 10,000. Otherwise they have reason to kill you. So they're not gonna get the full amount. So one big thing with collateral is that as the loan payment is paid, the life insurance goes down. So basically every time I pay a loan payment, the collateral goes down. I pay a loan payment, collateral goes down, loan payment, collateral goes down. The collateral assignment can never exceed the amount of the loan. So the collateral assignment can never exceed the amount of the loan. And when the loan is paid off, the assignment ends. So it's just a temporary transfer of rights in regard to a loan. When the loan is paid off, assignment ends. And that's there's
So,
actually, yes, go ahead.
so basically, an aspect, the insurance loan, it'll never be higher than the loan that you're getting from them, so that way they can't make money off of you dying, correct?
Yeah. So like if I have $100,000, or sorry, I have $100,000 of life insurance and my loan with them is $10,000. I will collaterally assign $10,000 to them for this loan. But every time I make a payment and the loan goes down, so will the collateral
So does
assignment.
the insurance, right? The collateral insurance assignment insurance. Okay, that makes sense. Okay,
And
thank you.
basically it's not like you don't need to tell the insurance, like it's not like you have to keep this updated by any means. What happens is like, let's say you die, the bank will go to the life insurance and say, here's how much was owed on the loan, give us that exact amount. And then they do that. And they'll be listed as the collateral beneficiary, and it'll just say you are owed as much as the loan is, but no more. Like you cannot collect more than the loan. Okay. Oh, and one other testable point here in terms of a loan, and this usually is going to come in the state regulations chapter. A bank is allowed to do that. They are allowed to say, in order to get this loan, you have to give us life insurance or buy a life insurance policy. They are, as a condition to the loan, you have to get life insurance. They're absolutely allowed to do that. What they are not allowed to do is tell you which insurance company you have to use. So like if you go to Bank of America and they say, we will give you a business loan, but you must get life insurance with Allstate, they can't do that. They can say you must get life insurance and we have a partnership with Allstate if you want to call them up, but they're not saying you must get it with Allstate or else you will not get this loan. That is actually called coercion. So coercion would be when they force you to get insurance through a specific company as a condition to the loan, and they are not allowed to do that. So yes, they can ask for insurance to back the loan. No, they are not allowed to tell you which insurance company it must be from. It can be whomever you choose, however you choose it, as long as it matches the loan amount, as long as there's enough insurance to cover the loan amount, then they have to accept that. They can't tell you which insurance company it must be. If they do, that is coercion, and coercion is illegal. They are not allowed to do that. And that is a very testable point. In fact, when I took the Colorado exam, I had that question like 3 or 4 times. Like, you went to go to the bank and they told you you had to get it through this insurer. What is that known as? Coercion. and you're not allowed to do that. All right, suicide. Okay, so this matches incontestability because it's a 2-year thing, although some states I've seen 3 years. If the insured, so let's say you buy a policy, and in the first 2 years that the policy is active, you commit suicide, the insurer will not pay the death benefit, but they will refund all the premiums. They will cancel the policy as if it never started and simply refund the premium to the owner or the beneficiary. Like if I'm the owner and I commit suicide, they will pay the premium to the beneficiary. But if the owner is still alive when the insured commits suicide in that 2-year period, they'll pay it back to the owner. Not that they test you on that, just letting you know that. What they will test you on is the 2-year thing. So any suicide committed in the first 2 years would not pay a death claim. They simply refund the premium. So they'll refund the premium as if the policy never happened. After 2 years, a death of suicide will pay out like any other claim. No questions asked. But again, like I said, there are some states that have a 3 years, or any state can always have a different number. But the majority of the exams are based off of ISO, and I teach ISO numbers. Okay. All right, policy exclusions. You see my typos there. Oh, well, I'm going to leave it alone. That's result. Okay. All right, so policy exclusion. So these are things that are not covered. These are things that they would not pay a death claim for. The first one being a hazardous occupation or a hobby. So hazardous means dangerous. So hazardous is dangerous. And then an occupation is a job and a hobby is a hobby. Okay. I like to jump out of airplanes as my hobby. I do that every weekend. It gives me such a thrill. That would be a dangerous hobby. So if you have a dangerous job or a dangerous hobby, they can either exclude you and say, sorry, we can't offer you insurance, or they can simply charge you a higher premium. So if you have like a dangerous job and you're like, well, we'll still give you insurance, but because your job is so dangerous, we're going to charge you a higher premium. Or if you, let's say you do have a dangerous job and they say, sorry, we won't cover the job. But if you died at the job, we won't cover you. But if you died at home, you had a heart attack at the weekend with your kids, family, whatever, we will cover you. So they can either exclude it or they can charge a higher premium for that one. The next one is aviation. So that means flying. Aviation is flying, being a pilot, basically. Now, big commercial airlines and passengers are covered. So like if you're a pilot of Southwest, you're a pilot of United or Delta, this isn't about you. Commercial pilots are different. This is about individual pilots. So like if you own your own plane and you like to fly yourself around, or you own a helicopter and you like to go from Southern to Northern California all the time, you would be a private pilot, and they would not cover any deaths that occur while flying your airplane. But commercial flights like Southwest, the pilot and the passengers are fine. So like if you as a passenger die on an airplane, you can use your insurance. This is only excluding personal pilots, people who have a pilot's license themselves and fly themselves around. The next one is war or military service. So most life insurance companies will not cover war or military service. That was one of the cool things about like USAA. So always make sure, as a life insurance agent, make sure you're asking, are you in the military? And then make sure you find a policy for them, or fully explain to them that this policy won't cover you. Now, the military does offer insurance. It's like SGLI. They offer that to all of their servicemen, but it's only $400,000. There may be a need why you need more than that. And then USAA doesn't have that at all because they're focused on the military. And a lot of newer, a lot of them are kind of not doing this as much, but they can. And for the purposes of the state exam, they're going to say most life insurance will not cover it. So now they're either not going to cover, and war works for anybody. Like because in war, you can't calculate the potentials of war. What I mean by that is like insurance has to be statistically predictable. So say, okay, you're a 40-year-old male with this type of heart condition. We can anticipate you dying by this point. That's statistically predictable. War, there's no predictions. If someone decides to drop a nuclear bomb in the United States, there's no way of predicting what's going to happen. There's no way of predicting the chances of someone doing that. So war is actually all around excluded, even for property and casualty, home and auto, because there's no way to predict it. Fortunately for us, there hasn't been a whole lot of events on US soil for us to be worried about. But the key thing that they ask usually is going to be about military service. So if you have a serviceman who wants to buy insurance, you need to be informed, is the policy going to cover him or not? And what are the rules? So sometimes they have rules. So they either say, we won't cover you at all, or we'll cover you on a status clause, or we'll cover you on a results clause. A status clause will exclude all death while on active duty. So if you're active duty, like even if you're just on base and your job is to clean big trucks, no one's attacking you, no, there's not at war, but you're cleaning a truck and the truck runs over you and you die, you are on duty, no payment, okay? If you come home, you're at home with your kids, uniform is off, you're not on the clock, then you die that way, then they will pay you. So status clause basically is saying, if your status, like it's kind of weird, but status, think of Santa, if your suit's on, you're not covered. Okay, so if you're working, you're on active duty, you're not covered. If you're suited up, status clause, suited up, you're not covered. Results clause says that they will only exclude deaths from an act of war. So if you were cleaning the big trucks and they ran you over, you're covered. But if you were attacked by the enemy, and you died that way, then they will not cover you. So active duty is okay on results clause as long as active duty didn't involve an act of war. Okay, so these can be the testable points here. And I'll clean up these spelling errors before I ship it on over to you guys. Like I said, I was kind of rushing. I don't normally make PowerPoints, but I want you guys to have a study tool because these ones are such a highly tested topic. All right, next we're moving on to, well, I'll say, okay, yeah, actually, okay. All right, yeah. All right, the rest of these, policy loans, automatic premium loan, and non-forfeit option are all very specific to whole life insurance. And it is best to teach them with whole life insurance. So for the purposes of this life provisions video recording, it's important to know, and for all of you sitting here and in the live boot camp, we're going to learn whole life insurance in a minute here. It's important to know that policy loans, automatic premium loans, and the non-forfeiture options are under the provisions chapter, which is a highly tested chapter. For the purposes of this video, I will not be teaching them in this video because it's so much easier to teach these alongside whole life. So just make sure that you watch the whole life video and that you pay super close attention to policy loans, automatic premium loan, and non-forfeiture options because they actually come from the more highly tested chapter of provisions. So that means that for this video, we're going to end at settlement options. But I am skipping 3 major provisions, but I will be teaching them alongside the whole life video. Okay. All right. So settlement options. So this is basically how the beneficiary receives the death benefit. How the beneficiary receives the death benefit. Now, like we said earlier, when we learned about ownership rights, the owner of the policy is the one who has the right to decide. So like going back to an example of my gambling grandma, and we'll kind of use her to talk about some of these, okay? So if my grandma has a gambling addiction. If my grandpa were to die and his life insurance pays out to her, if it paid out cash lump sum, she's boom, here's 300,000, your husband just died. What is gambling grandma going to do? She's going to go to the casino and blow all of it. We don't want her to do that. So this is where the owner of the policy, like my grandpa, if he bought the policy on himself to pay out to my grandma if he died, he gets to choose which option is going to happen. Now, if the owner doesn't choose, then the beneficiary will get to choose. So it depends on if the owner picked, then it has to be whatever the owner said. If the owner said nothing and made no indication as to what settlement option they wanted to happen, then the beneficiary will get to choose. Okay. So the first option is just a cash lump sum. You just take the full death benefit amount in one payment. Full death benefit in one payment. Now, the biggest thing about this is that, and this is a selling point when you are selling the insurance, is that this is a tax-free check. Tax-free check. Life insurance payout is a tax-free check. So when you're sitting there and you're explaining to a couple, you know, like one of you dies, you need money to take care of the kids. One of you dies, I'm going to bring a check to you for $100,000, $200,000, whatever it is, and you won't have to pay any taxes on it. No taxes whatsoever. It is a tax-free check. You get to use all that money free and clear. No taxes will be owed on it. And that is the cash lump sum. It is the full death benefit and one big payment. 300,000, 500,000, whatever the death benefit is. Here's a check for that exact amount. Spend it wisely. And it is tax-free. Interest only is and again, this is the memorization here is Cliff. So CL, I kind of put them out of order because it just, you know, I want to put all the L's together, but CLLLIFF, Cliff, for memorization. So interest only, this is a great option. Like, let's say we have a young mother. She's got 3 young children. Her husband just died and she's grieving. She's not in a space to make wise financial decisions, but she needs money to feed the children, to pay the mortgage. Interest only option will basically, the insurance company will keep the lump sum. They will invest it for her. And when it earns interest, they'll cut it off the top and send a check to her. So they're keeping the bulk primary balance in a holding space for her until she figures out what it is she wants to do, until she's able to actually sit down with a financial counselor to figure out what it is she wants to do. But in the meantime, they'll start sending her interest payments. So they'll invest the money for you. They'll save the money for you. It's growing interest. It's earning interest. They'll send you that interest off the top until you're in a space to figure out what you want to do. So some people may do interest only for a little bit and then do lump sum. So interest only isn't forever. It is a temporary solution because ultimately they owe you that principal balance. They owe you that money. It's just if you don't know what to do with it or you're trying to figure things out, you can do interest only in the meantime, where they take that lump sum, let it grow interest, save it for you till you figure out what you want to do, cut you the interest off the top. The only thing with interest only is that your payment will be taxed. Your payment will be taxed. So when you receive an interest only check, interest is always taxed. Interest is always taxed. Interest is always taxed. That's what you want to think of for the purpose of the exam. Not on whole life, because that one's special. As long as whole life stays whole life, it's like the one policy, and I think universal too, but if it stays insurance, you don't have to pay taxes on it. But once it pays out and it's earning interest, then you have to pay taxes on that. So when you receive an interest only check, that's extra money that's coming to you. The lump sum is tax-free, yes. But once that starts earning interest and making money from the money, you're going to have to pay taxes on that because that's extra money coming to you. So when you have an interest only check, that payment will be taxed. All right, the next one is life income. And this is where they take the lump sum and they will pay it out to you for the rest of your life until you die. This is what we would choose for gambling grandma, because we don't want to give her the full 300,000, whatever it is, and then she goes spend it at the casino. But we do want to give her enough money to pay her bills and to feed herself every month. Because she'll at least do that. She's capable of doing that before she goes to spend the rest at bingo. So life income is awesome because and when they say life income, they mean for life. Meaning, so let's say that with life income, and I'm just gonna open up a whiteboard here because I can draw easier on the whiteboard. It comes out better somehow. What is all this? I don't want all this. I never use this computer other than to teach. It's my whiteboard, literally. Like, it allows me to write and draw on here, but it is not my computer. This is my computer. This is just my whiteboard, but I can somehow, for some reason, it's easier to draw on the whiteboard than it is the PowerPoint. All right, so let's come over here real quick. I'm going to turn this black. It's easier to see. Okay. Now this is actually an annuity too. So life income is exactly how an annuity pays out. But we'll get into annuities later, but just plug that into your mind. Life income goes with annuities. Annuities are actually the opposite of life insurance, where life insurance is, I'm worried that I'm going to die too soon. An annuity is, I'm worried I'm going to live too long. And live too long means live past your money. So like if you have $1 million, you spend it all, you think you're going to die at 90, you spend it all, you're 90 years old, you're still alive, you owe money, you still need money, but it's all gone. An annuity is what will make sure you always have money because they give you life income. So I'm going to draw it out kind of like an annuity. So like imagine that this has racked up all this money. Okay. So let's say grandma got $300,000. What they are going to do is they're going to say, okay, we anticipate grandma living for the next 20 years. So let's say grandma is 70 years old when grandpa dies. And actually, let me draw it over here. This will make more sense. So this is when grandma dies or grandpa dies at 70. So his life insurance pays out to grandma, $300,000. But we're not going to give it to her all at once because she's going to blow it all. So she's at 70. We anticipate her dying by age 90. What's going to happen between ages 70 and 90 is that this amount of money will pay out to her as a monthly check. A monthly check. Okay. So basically every month she is draining this account. And so every time we send her a check, it drains the account. Send her a check, it drains the account. Send her a check, it drains the account. Send her a check, send her a check, send her a check, send her a check, send her a check. By the time she is 90, this is all emptied out. Okay. There is no more money left in the account by the time she is 90 years old. But what was it called? Life income. This is where wherever she lives beyond the money, let's say she lives till age 100, they will still send her a check. That's what makes life income so cool, is that you are guaranteed income for life. Life income. So she will continue to receive a check even if all the money is gone. So they will estimate, they usually will overestimate, like they'll give her, they will assume, like given her health, she probably lived till she's like 80 something, but will overestimate till 90 just in case. But crazy miracle, she drinks kale every day, who knows, lives till age 100, they will still send her a check, even though all the money is gone. And that is the beauty of a life income. And that's how an annuity works. So the whole point of an annuity is that you save up money, but if you run out of the money and you're still alive, they'll still send you a check. Now, here's the bad part. What if this is still all filled up with money and they're sending it to grandma, but grandma dies right here? What happens is that all the money left over gets to be kept by the insurer. It will not go to anyone else in the family or anyone else at all. So this is the negative side to life income, is that if you die before the money is spent, any money left over gets to be kept by the insurer. Okay. The beauty of it, live longer than the money is, you still get paid. The negative side, die before the money pays out, your family loses everything that's left. Okay, that is life income. Now, if we were to go back to the PowerPoint, we have two other options: life income period certain, life income. Yeah, that one does. I mean, that'll be the same, but the key thing here is period certain. What this one will do is this one will say, okay, so let's start fresh, right? So we have this account of money and it's all filled up with money. And we anticipate grandma living from 70 to 90. Period certain will say that no matter what, for at least 10 years, the money must pay out. Okay, now, if grandma lives from 70 to 90 all the way to, let's say she goes to 95, the period certain doesn't matter because she's getting a life income no matter what. Remember, it's called life income period certain. Life income period certain. Okay, so no matter what, if she lives beyond the money, she's still going to get paid. What the period certain does, so the period certain says that for the first 10 years, even if grandma were to die 1 year in, the money must continue to pay out for this period. So at that point, there would be another beneficiary. So maybe instead of grandma, it would go to her daughter or something. Someone in the family would get the money, and that's period certain. So this is a way of keeping some of the money safe, some of the money protected, so that if grandma does happen to die before all the money runs out, at least there will be a set period of time that we'll be able to collect the money, and any money left over that would go to the insurer, yes, but at least we got to collect 10 years worth. Now, the difference too between life income here and life income period certain is up here under life income, grandma could expect, maybe a $2,000 check a month. Down here, she might get $1,200 a month. So you're when you choose period certain, you reduce your monthly check because they're guaranteeing that you're going to get that amount of money. So they're going to reduce how much they pay you. Okay. So that's a key thing because like you're like, why not just choose period certain? Duh, it protects the money for the family for a while. Well, you just have to realize it's going to be a lesser of a check, which may still be worth it, but just keep that in mind. Okay, so that covers life income and life period certain. So that's where they take the money, they put it into an annuity, essentially. They pay monthly payments out to the person. Life income, they pay it until they die. Any money left over gets to be kept by the insurer. Life income period certain, they'll pay it for life income. And if the person dies early, they'll still pay it for the period certain. Once the period certain is over, then the insurer gets to keep the money. You can also have life income joint and survivor. What this will do is it's basically paying out to two people. So let's say, and this could actually be, let's say that you are responsible for your parents, meaning that as they age and they get older, you're the one taking care of them. And you're worried that if you die, that no one will be there to take care of them. So you actually get a life insurance policy for your elderly mom. Like it's on your life, but it'll pay out to your elderly parents. So it's going to pay out to your elderly parents. And what this will do is it's life income joint and survivor. It's basically saying that there's two people. What they'll do is when both people are still alive, they'll pay out a full check amount, whatever that check amount is. If your dad were to die and it's just your mom's left, they might cut the check by 2/3 or 1/2, whatever you chose. So this is where it's paying out to two people. And what happens if one of those people die? They will cut the check by 2/3 or 1/2 for the remaining person still alive, whichever one you choose. So that's life income joint and survivor. And all of these, other than all of these, well, they have life income period, certain life income fixed amount on annuities, but all of these come on annuities as well. All right, the next one is fixed period and fixed amount. What this one is saying is if I have, $100,000 to pay out, and you say, I want payments for 10 years. This is called fixed period. This is called fixed period, where you say, I don't want a lump sum, but I want you to cut it up, divide it up for me over the next 10 years. So they'll say, okay, 100,000 divided by 10 years is this much money. We'll send you a monthly check for this amount. Okay. So that's fixed period, where it's focused on how long you want to receive the money. Fixed amount says, I want a monthly check. I want a monthly check for $1,500. So they'll say, they just work backwards. So they say, okay, she wants $1,500. We've got $100,000. They do the math and they'll determine how long you'll get that. So you either focus on the period. I want money for 10 years and they'll divide it up. Or you say, I want a monthly check for $1,500. They'll take what's available, pay you $1,500 until it's gone. And that's fixed period, fixed amount. And on annuities, you can have life income fixed period, where they have to pay out for 10 years if grandma were to die. Or they have life income fixed amount, where it's not so much about a time period, but a certain amount of money that pays out. But we'll get into that when we do annuities. So again, these are all your settlement options. When you have, so remember you have dividend options, and you have settlement options. Your acronym over here for memorization is CRAPO, and your memorization over here is CLIF. Okay, so I crapple my pants when I fall off a cliff. And as weird as that is, I mean, I assume people might do that, but it's all for the purposes of memorization. You will remember that when you're sitting down at the test. You go, what are the dividend? Crapo, I can't remember the dividend options. And if you watch, what is that TV show? Disenchantment on Netflix. That's what they name their elves. Like his name would be Crapo. Anyway, going off on a tangent. So those are your memory tricks there. So this is the abbreviations, CLLLIFF, and then your dividend options, CRAPPO. And I would encourage you to actually make a flashcard and write those out and have those memorized, because they do love to ask about those. And remember, this is coming from one of a highly tested chapter, one of the more tested chapters than any of them on average. So on average, no matter what state you're in, life provisions, life riders, life exclusions, including the dividend options, are highly tested. And again, I want to remind anybody watching the recording, policy loans, automatic premium, and non-forfeiture options are included in life provisions and options, but I will be teaching them in the whole life video as they go along with whole life. Okay, any questions here in the group before we shut this recording down? Okay. All right, I don't see anything, so I'm going to shut the recording down. And whoever's watching the recording, all the loves, all the vibes to pass your exam.